Welcome. Thanks for joining in. Another edition of Amp Life Team Call on Mondays. So forgive me, we're running a couple minutes late. Reason being, I need to call Foresters and ask for one specific question that I didn't get the answer to last week. So we'll get this thing rolling. Make sure, yeah, I'm not muted. Okay, good. And so last week we did the Smart UL, which is a universal life product. This one's kind of its close cousin. It's a participating whole life, so major difference off the bat. We're looking at a fixed cost of insurance. So what that means, the UL, it goes up every single year. A small piece of the cost of insurance keeps going up with the hope or the plan, if it's structured properly, that the interest rate that it's making is going to outweigh the cost of insurance where you can maintain the same premium. Well, have you seen some failing universal life products from clients from previous companies or from their auto insurance companies? You kind of notice them going backwards, or they require them to have a lot more premium, or they took out some type of cash or a loan and they haven't increased their premium to pay it back. It starts eating away at that cash value. That's all because of the cost of insurance. Because they're not putting enough money into it to where it's funding it properly so it can get over that hump and keep on producing income and growing the actual policy before it lapses. So Vantage Plus can be a really good option. We'll do first, we'll break down some of these different sales points, which is on, should be this right here. Yeah. So, like I said, participating whole life, they have a 20 pay and a 100 pay. Meaning 20 pay, you only can pay on it for 20 years, then you're done paying for it. And depending on the dividend setup, which we'll go over those, there's three main ones to look at. That policy can keep building even though you're done paying the 20 years. So it's really good for some of the younger clients, especially the juveniles. You're able to get them into a product, get them some coverage, and then basically be done paying for it. It's only a subtle difference. It's usually about a $2 to $5 difference between a 20 pay versus 100 pay. And that juvenile policy is almost like a children's whole life type of deal. You're only going to pay on it for a certain period of time before they actually can take on the actual product. So a couple different ways. So it goes from 0 to 75 on the non-medical side, 25 grand to a maximum of 400,000, which we'll explain that once you get to how they use it for a mortgage protection setup. With anything on Foresters, the most coverage you can write is 400,000 in total. So that can be 25 on Advantage Plus, another 375 on a year term on the rider. As long as it totals up to 400,000 or whatever the maximum amount of coverage for those particular issue ages are, that's the most coverage you're able to write between multiple products, not just one. So Stage 121 does have the built-in benefits from the common carrier, family health benefit rider, the accelerated death benefits for critical, chronic, and terminal illness. So same exact setup as every other product that Foresters has. And like I said, what I like, I said, is the issue ages. So for participating whole life, which means it's different from a final expense whole life product. I mean, this is going to build an interest rate on that cash value. It's a little bit higher, as well as accruing dividends. So the guaranteed rate currently on the Vantage Plus is a 4% rate. With their dividends option is at a current average of 5.5% market rate. So that's actually a pretty strong dividend because I think Foresters, they bring in close to about 6, but they're crediting almost 5.5% on the actual dividends for their whole life, which in terms of the marketplace and the participating whole life space, only the one that we really have or really could use would be the Rural Neighbors option, which is a higher minimum to start out with. Unless they changed it down to 25, it used to be 50,000 was their minimum to get rolling with. So it's a little bit more user-friendly product, a lot better interest rates on the actual consumer side as well. And for the right situations, it's a pretty solid product to actually use. So going into it, let me go back to the main screen. So this is obviously the Foresters homepage, and down here, there's an online illustration software, as well as the option to download it to your desktop as well. So more times than none, this is a lot more stable, even now on iPad. So I do a lot of illustrations for my iPad. So therefore I use the online version opposed to the downloaded version on like a PC. And then we're going to run a case that Rick did. 66 mail. Yeah, that's all good. So I'm gonna leave that here for a second. So cool thing about Foresters. So if you go to the Foresters quote website, so which is forestersquotes.com, that's to give you all the different the quoting engines for all four of their actual products. Nice piece with that, they also have some resources for the term, underwriting, whole life, participating whole life, as well as their universal life guide, along with their plan right. But down here, there's some needs analysis tools. So you can get into these and figure out how much they need for funeral coverages, from cash flow. They kind of give you some nice little options to kind of plug in some figures and spits out kind of how much insurance you actually need. Ideally, set up for other appointments, unlike or mortgage protection, you're kind of just doing a family friend or someone who's looking for insurance. You want to kind of go through some different metrics to kind of figure out how to calculate how much insurance they actually might need. But for this one, today we're going to talk about the mortgage protection tool. So this one's designed for the Advantage Plus product. We're able to put in the loan principal amount. So say $200,000 loan, their annual interest rate, so whatever the current rate is, which right now we're about a 4.5. I can type. Oh, let's hold numbers. Okay. I think the Feds has made it at 5% or 5.25 rate. We'll run with 5, as well as their loan period. So we'll say it's a 30-year loan. By doing this, it basically tells us, it basically spits out the answer of how much coverage we need to have in both products. So looking at a $200,000 loan, annual interest rate about a 5%, loan time frame is a 30-year plan. It basically tells us how much coverage we have to write. It breaks down how much Advantage Plus whole life, so we need the 101,000, and then on the term rider, which they do a 10-year as well as a 20-year term rider, you need to have a $98,000 rider put on there as well. So what that's meaning, for the first 20 years of that product, we're going to have, starting out at the right $200,000 amount, and as time goes on, which this Advantage Plus is actually going to keep growing, but when that term rider falls off after that 20-year point, they're still going to owe a balance about $100,000 on their actual mortgage based off of this APR right here, the 5% rate. So it's a little cool tool that instead of using the guesswork, you can use Carl's mortgage calculator as well. You can get a more concrete number. I think you can put in the property taxes. It's a little app you can download from the App Store, whether it's the Apple Store or Google Play. It's a real nice little app that to use to kind of get you a more accurate figure in terms of pulling the actual property tax rates. So you kind of get a more accurate number of what they're actually paying on a monthly basis to kind of compensate. But from a baseline approach, which so we're going to run this exact situation real quick. So 101,000. 101, what was it? 7 or 224. All right, and then we're gonna do a rider. I want to change the age of this person to 35. And we'll get back to that Rick's case in a second, just to show you how that calculator would look. Term 20, 98, 776. Yeah, 776. And we'll hit at a glance. So this is that first case, or just running off of someone that has a $200,000 mortgage, say they're 35 years old, and they totally get it. They want mortgage protection. They want to cover the whole entire balance, but yet when that mortgage is done, since they're already in their 30s, if they're done in 30 years, they'll be age 65. They're going to want something to show for it as well after. They don't want to backtrack in terms of getting a brand new policy started 30 years later. They want to kind of get the one-stop shop, get it all done at the same time. That's really where that Advantage Plus can make a lot of sense. So it looks very, very similar to a UL illustration, except there's a lot more columns, right? So you have your annualized premium is this one, your guaranteed cash value is that column, the guaranteed death benefit shows how much coverage it actually is. Just if it got 0% interest the whole entire time, which that won't ever happen, here's how it will still look. It'll still have coverage amounts still locked in. Their annual dividends, the money that they're making on the actual policy. And then over here kind of goes up to the paid up additions. So out of the about 3 to 4 different ways of getting cash value built or getting a dividend from them, paid up additions is the one that usually performs the best, meaning that illustrates the best, as well as it shows a lot more accumulation happening on that actual whole life death benefit as it keeps growing the longer that they actually have it. As well as you got your paid up addition cash value. So if you were to ever surrender the policy, here's how much cash value that they'll be paying out as well, opposed to what's the dividends worth, as well as your traditional cash value being built on that whole life product. So that's where the total cash value comes in. It's adding up a couple different things in here to get the total number of their total cash value. And obviously your total death benefit, this is with everything included, even the paid up additions. So the cool thing, just to show you, so we did a 20-year term rider. So it means for the first 20 years of the actual policy, they're actually, as their mortgage balance keeps going down, their death benefit is going to keep going up. They basically gain about another $25,000 worth of death benefit during that first 20 years of that period. So assuming that they're paying on their mortgage and they know that 20-year term rider is going to fall off, once that 20-year term rider falls off, where they're not going to owe that full $200,000 amount, that 20-year term rider falls off, then they're down with the $128,000. So if you remember, our whole life portion was $101,000 to start, then we did the term rider for $98,000. That's how much is going to be left. But if you notice at year 21, you're like, well, how is it $128,000? Well, that's this fancy thing called paid up additions. So that $27,000 right here, added onto that 101, gives us that 128 and change, right? So as they're getting older, and what's basically left on that mortgage for the next 10 years is not going to be the true 200,000, closer to that 100 amount. That's where this product really shines. It's a lot of them have that permanent coverage already established, so it gives them a little bit of flexibility options in terms of if they want to take the cash value the next 1 to 5 years after that 20-year mark and use that to liquefy and pay off the mortgage. They have that option, surrender everything. Or as they're working on paying off that $100,000 balance, they still have enough death benefit to cover that, as well as they're getting older, they're going to be able to still grow that progressively growing death benefit. So even by the time they're 85, you know, we started off with a product that was $200-something policy with the combo of the term rider as well as the whole life portion. Well, as that dividend keeps growing, at 85, we've grown another $122,000 inside that paid up addition, and our original whole life was $101,000. So now their current death benefit is $223,000 again as they got older. So it's a real good product in terms of being able to leverage interest rates, leverage their actual money, covering them the full time from start of their mortgage. But they said they want something that's a little more permanent, and it's only $142 a month for them to have a permanent plan, which after that 20-year period, that rider's going to fall off, meaning that instead of being $142 a month, they're at $1,481. So they're still paying about $123. So that rider for $100,000, give or take, was roughly about $22 a month, $23 a month to add on, and it's going to fall off after that 20-year period. So for a younger person that's that gets that whole idea of, I don't want to end up like my parents struggling to get covered at a later age, or I want to do kind of a one-stop shop now. I want to build some money, still have a term option. This can be a really good alternative to that universal life product. What it does, it's able to leverage participating whole life, which, as you know, the guaranteed rate is a 4% rate, while on the universal life options currently, it was just a 4.1, and they just changed to a 4.3. So it's a very similar rate on a participating whole life, but yet the cost of insurance is remaining the same the whole entire time on that whole life portion. It's not going to change. So only reason this changes is because we had a term rider that was on there that fell off after that 20-year period. As well as their dividends, this portion right here that keeps growing is growing at a 5.5% interest rate currently. So looking at it from that standpoint, you're able to do that, as well as except giving them some good coverage to start, but yet something to fall back on during those later years that's already established for them. Same token would definitely apply for people that are younger that want to kickstart some type of savings program, which is a lot of different sales techniques for this product other than the mortgage protection space. People that want to get college savings accounts. Forrester does a really good job. Kind of get some sales concepts down here. If you go down to their Advantage Plus tab and kind of go through their product highlights, you get down to, let me find the right page. Where's it at? They moved it. Oh, sales concepts. Here we go. So they have a college planning fact sheet, which really, from a consumer standpoint, gives them an idea of how to use college savings and what the benefit of it is. But it also gives us, from the agent standpoint, the kind of the setup we're actually looking at. So anytime about college savings, you can put them on children, that you can do that. But in reality, those types of plans are actually on the actual adult, meaning that you want to put a substantial death benefit on them for if the parent did pass away and they're planning on helping the child pay for college or leave some money behind for the kids for college. You want the benefits to be on the actual parent, whether it's, hey, they have a 1-year-old and they want to put them through college in the next 20 to 22 years. They want some cash to help them. Well, if that parent passed away during that 20 or 22-year period, there should be enough death benefit for that child to have enough, about 4 years worth of college, or even if there's multiple children, enough to get a lot of them started throughout school for one or 2 years and then kind of get that ball rolling for them. But the reason you also do that, since the adult's going to have a higher monthly premium, what that allows them to do, it's growing the cash value a lot faster than if you had a juvenile policy, to where, say if it's only a $20 policy, it's not going to grow as much. They might have $2,000 to $5,000 worth of cash value to use, while the adult, if they're paying a $200 or $300 a month premium, they might have anywhere between 70, 80, 90 grand worth of cash that they have access to. Even on our illustration here, after, say, that 20-year point, let's go down, cash value. You're looking at almost about 33 grand, almost 40,000. You get down to some of these later years, depending on when they start having children. Now, mind you, this is a lower funded product. It's only at $142 a month. Typically in college savings, you want to be upwards of $200 to $300 a month, which, let me just switch a couple numbers in here. So instead of do this at do it at 275. Still keep that term rider on there if something were to happen in the first 20 years. This one, now we're at a $343 a month payment. So we got 275 whole life coverage. Still got the term rider on there for another nearly about 98,000. So for the first 20 years, something were to happen, there's $442,000 worth of death benefit. And this is what I'm talking about, that 90 grand. So if you're in that range, like I said, about 300-ish. You should be able to get anywhere from 70 to 90 grand worth of cash. So if the parents wanted to liquefy this account and use that cash value to help take care of colleges, they're able to do that. Especially in between years 20 to 22, depending on whenever they have children, whenever the children starts college. I mean, you're looking at 90 to almost 106,000, that's growing at almost 8 grand every single year in terms of the total cash value. So that's what you want to look at in terms of how can we leverage a product for them to take care of college expenses, as well as, God forbid something did happen to them, they have a lot of death benefit to be paid out as well. Take care of, depending on what school you end up going to, you might have $20,000 a year, $50,000 a year. It all just depends, but still having, God forbid the parent passed away, nearly $400,000 to get paid out. And if they have multiple children, that's a lot of money to take care of some living expenses, as well as kickstarting their whole college career for them. With that, are there any questions? So let me go back to this. I'm going to unmute everyone. If you have any questions, please chime in. You should be all unmuted now. Any questions, anyone?
No. Hey, I got a question. Are you going to have this up? Because I was listening half, unfortunately, but I want to hear the whole thing from the top. Can you put it up so I can listen to it just hopefully tonight or tomorrow night?
Yeah, I'll have it posted. I got the other one posted too, so today's a slower day. Still recovering from the housewarming party, so if you're here,
be careful.
You know why. So it was a extravaganza, to say the least. So yes, this will be posted with the other one. But with that being said, Rick, we're gonna use your case that you told me. So Rick had a case, which I'm gonna mute everyone back out for a second.
Okay.
So Rick had a case last either Thursday or Friday, and I believe he was 66 male, had a $200,000 mortgage, and I believe the gentleman went for, it was $100 grand on a 15-year Mutual Omaha TLE, which ended up being, let me run the exact quote to show this real quick. Hold on. Term Life Express, we're looking at $66 male, 15-year, 100 grand. So that was right at like $250 a month. So that came up to be, it was $250.09 a month for $100,000 over the course of a 15-year policy, right? So we have to talk in, and like I said, at that kind of age, and you definitely want to look at something that's going to be term, take care of the mortgage, but you also want to start peeking at some type of whole life products. So we got talking about it, and we came to find out that if we would have wrote a Smart UL or Advantage Plus, excuse me, which was 25,000 of whole life, and then we do the dividends, or excuse me, riders. And I think if it was a 10-year term for 75,000, essentially we can get this guy almost the identical same setup, to where while the next 15 years he'll have that same 100 grand. So we did 25,000 whole life coverage, did a 10-year term rider for 75,000. Monthly premium in this case is $232 a month. So it's about what, $28 cheaper than Mutual Omaha, just on a basic 15-year term. And what it's going to do as well, about the same premium over the next 10 years, so he'll still have his 100 grand. Then once that 10 years is up, the 100 grand drops down to $28,000. So instead of that term expiring, he's going to have something else to fall back on during those later years. As he progressively still gets older, he already has a whole life that's still building up for him. So the longer he's had it, the more cash value or more death benefit he's going to have inside that product. So it's kind of a play to, instead of giving him just a 15-year term that's going to get him to age, what was that, age 81, we can have him a policy that's going to last until past age 100. He'll still have a decent death benefit on there. And while those working years of him doing his job still, even if he plans to work another 5 years, 10, whatever the case of it actually is, depending on his job, he'll still have that $100,000 death benefit. Same thing can be done while, if you write the term rider with the actual product, it takes care of just having one policy fee versus having two. Compensation is a little bit different if you write the term rider. If you look at your schedule, it is a little bit lower if it's a combo. But a lot of agents do, they write them separate. So the separate piece, not only do you get a chance to kind of really pick and choose and dive into the different term levels, but you also get your full compensation while doing that. Only caveat, it is going to have a separate policy fee. But for things like this situation where we can still say get him a 15-year term instead of a 10-year term, kind of overlap it. We're looking at, so in this case, I would be doing, it was 174.98 on a 15-year. 10-year was 127.08. And so this is where it kind of gets tricky. You got to do a little bit of math to kind of look at these different numbers, because how much was this without the rider? 149, 1479. So 1479 divided that by 12, that's what the whole life portion cost. That's 123 a month for 25,000. So even running it separate on that 10-year option, we're going up to, he's at 232. So running it as a combo, it's 123.25, plus if you run a 10-year term separately, plus 127.08, it's at 250.33. So it's that $28 difference. You're getting a nice little discount if you do the term rider throughout the product. But because of that policy fee and so forth, it's going to be a little bit higher premium to compensate for. So we're looking at about a $28 difference still. So in that case, what I would do, say, hey, we're really trying to get him that higher death benefit, not only to last that 10-year portion, we really would like that to last closer to 15. So I would go back to this if I wrote it separate, and let's reduce this down to 50 grand, right? So use this as a little benchmark example. So now we're at 118. So we do 50,000 on the 15-year term. It's 118.70. So 118.70 plus, looking at 123.25. Now that total is 241.95. So in order to, you can't really illustrate, that's the only caveat. If you do them separate, you can't illustrate it and show the client how it actually looks. So the best thing to do is if you just do the at a glance without the rider, and then we're going to show them at the 15. So basically for the first 15 years of this policy, we can add just $50,000 to these death benefit amount that's illustrated here. This is just the whole life portion of it. So just to give them the true numbers, the whole life will still grow the cash as normal. And that term rider, the other 50,000 is just going to sit here on top of these numbers for the next 15 years. So even down from starting at 75,000, progressively growing all the way down to the 15th year, we'll have $80,000 worth of coverage. And then that 50 is going to drop off, leaving him that same 31,000 going forward. And that's technically $9 cheaper than what Mutual Omaha was doing for the 100,000. And from the standpoint of being able to do it for 232, have a 10-year rider, it makes a little bit of sense as well. So the reason I would do it separate for certain cases like this one, where they're really adamant about having a higher amount of coverage instead of just lasting that 10-year period, the trade-off would be to, hey, we can get you into that same price point. Now we're going to drop off about $25,000 worth of coverage to keep it within budget. But instead of that policy, you having $100,000 of coverage and nothing to show for it after that 15-year point for about the same premium, we can just scale the coverage back slightly and still have a policy that's going to be permanent. You'll be able to keep it beyond that 15-year period. You don't have to worry about shopping for another insurance policy afterwards. So, because if you think about it, at his age, at 80, 81, the current cutoff age to buy any type of insurance is age 85, right? So that means unless he's going to be starting to convert his policy very early on, which some companies enforcers, it's up until age 70, they can start converting. Mutual Mahals, they're a little bit different in terms of their actual guidelines. So every company is slightly different in terms of when you can convert, whether it's after a set number of years or if it's prior to a certain age. There's a lot of different caveats to fall into, so you got to understand how those different things work. But if you want to take some of that guesswork out of it and say, hey, gentleman really wants a permanent policy, but yet we still want to get him coverage at a higher amount the whole entire time, that's where you want to look at either a Vantage Plus product with a term rider. So while that mortgage option is going to be temporary, you can temporarily stack this death benefit with a higher amount, as well as even that permanent feature, looking for something that's going to be there the whole entire time and not fall off on them. You pair it with the whole life option, or even looking at that universal life option as well to at least get a little bit more coverage. Typically speaking, did a UL, it's going to show up a little bit cheaper, but the trade-off is going to be we're not going to build as much cash value inside those policies, or you run the risk of it lapsing out at a lower age to maintain the right premium. You might have to overfund it a little bit extra for it to actually last the whole entire time. And you still might have 70, 80, $90,000 death benefit, which isn't the true 100 the guy was looking for. So definitely pros and cons, but that's the exact reason why we're talking about both of these different products. They're similar in nature, but the true capabilities of them are totally different in terms of understanding where one fits in and where the other one doesn't. There's not a rhyme or reason why you would go for one and not the other. It's really just looking at the illustrations for both styles of the actual product to see, hey, which one's going to be a better fit. Typically speaking, if you're looking at someone younger, I would lean more towards a universal life option, simply because they usually want to grow a little bit more cash value. They can overfund it, or you can do what we talked about last week, the guideline level premium, to where you can figure out how much money they want to spend on that product to start. And then you can plug into it, okay, here's how much death benefit is going to spit out to start with. While the Vantage Plus, you can't overfund the whole life portion. It is a fixed cost product. So meaning if they want to have, hey, I want to spend $200 a month, well, granted, they're going to have a higher death benefit on most options, but in some cases that could be a lower death benefit option because it's a fixed cost of actual insurance, which whole life tends to be a little bit more expensive than a universal life product. So for example, if we did, here, let me just backtrack, show it this way. We'll go to, let's go to a smart UL. We're going to quote for 25,000. So 25,000 on a universal life option, the smart solve premium is 107.27. While the whole life side, we're at 123.27. So that's about almost a $14 difference, right? $17 difference, sorry. So it's it's not terrible, but understand that they are different in terms of, okay, in this option though, we can technically spend that 123 and have it perform a little bit better than this Advantage Plus would, maybe even have a little bit higher death benefit to start out with. But the interest rate, it's if the current market rate's 4.3%, this is guaranteed at 4%, and the dividends on the paid up additions are looking at a 5.5%. This one should grow a little bit better because it is also a little bit more expensive. So it's picking and choosing the different battles, as well as this universal life option on the simplified side. You don't have the paid up additions to even fall back on. So that death benefit, that 25,000 is going to maintain 25,000 a lot longer in that policy until there's enough cash value generated for it to kickstart and start going up. So you'll see that difference as well on the Vantage Plus options because it has that dividends. And in this case, we're using the paid up additions. That death benefit will keep growing for the actual life of the client. So someone older, I would probably lean more towards this setup. Yes, it's a little bit more money, but if their back's against the wall in terms of their life clock is ticking, having a death benefit that's going to progressively get bigger, it's a little bit more attractive to them for that subtle difference of premium that they're going to be spending. So if you show them the options of, mind you, these have to be healthy. It's the same underwriting for both Advantage Plus, year term, and the Smart UL, so they have to be term healthy. But you show them the options of, hey, for $17 more a month, this death benefit is progressively getting bigger, as well your cash value is growing a lot faster. It becomes a lot more attractive than spending the 107 a month and having that constant 25,000 riding out until he gets about probably into the 20th year, where that cash value builds up enough to surpass the death benefit for that death benefit to start building and growing higher for him. So it's one of those things where you got to definitely run both options and be familiar with both setups. And there's been times to where I had a guy that was about 61. We're looking at the same exact setup, and the UL, which is what I knew more of, was my first option until I looked at the Vantage Plus options. And the only thing I did was I reduced his face amount down to about 40,000. So what it did, it matched up premium wise. So for example, let me run this one. We were at 50, he was 61. We're looking at $50,000 of a UL, which was, I ran this option at 160 a month. And then that same thing on Advantage Plus, 61. I started this thing out at about 40,000. It was 148. So subtle difference. So like I said, we were funding this at 160 a month. And then actually we got him started at 42,000. So what we'll do is this, specify premium. So just to keep it equal, so you hit this case design option and you choose, it's automatically set up for death benefit solve, which is pretty standard on Advantage Plus. But in this, for instance, I want to run it backwards. Hey, I want to see how much coverage he's going to end up getting for $160 a month. So yeah, this is the right case, okay? So for that same 160, I showed him on a Smart UL, which had him starting out at 50 grand a month. I decided to peak at Advantage Plus and do the same exact setup based off of that premium. It was 160. And his initial face amount started about 7 to 6.5 lower than his Smart UL option. But the caveat was, by the time he got down to that 12th year, he's already at the same 50,000, and this 40 grand was progressively growing. Not to mention his cash value was growing a lot better as well. And he was a gentleman that once he just wanted a one-stop shop. He didn't want to mess with it later on. For a subtle difference starting out at almost $7,000. this was a lot more attractive to him was, hey, we can start lower, and then as I get older, it will definitely build up to where I want it to be, as well as go beyond where I wanted it to actually be at policy-wise. So by the time he gets into his mid-90s, which longevity was on his side, his mom's 92 or 94, in that range, instead of only having a UL that might have been worth 50 or almost 60 grand, we can have a whole life product that's going to have 75, almost nearly 75 grand in cash and almost a $90,000 death benefit by the time he's 95. If I would run this side by side to the smart UL, like I said, you'll see this 50 grand being a constant almost for 20 to 25 years before it even starts going up beyond that 50,000. Well, it's the Vantage Plus, we're already ahead of that 50,000 in what, 12 years, right? Yeah, the 12-year point. So and that's gonna be some of the major trade-offs between the two different products. With that being said, let's peek at the dividends. There's a couple of different options. Like the most popular in the base setup is always going to be paid up additions, meaning how you see the death benefit growing, as well as that some of that cash value growing is because of you're electing to have, instead of getting the dividend money in cash, you're letting it buy some additional coverage portions for you. Dividends on deposit, that's essentially a savings account through Foresters, where you can just build up that dividend cash and it sits there that you have access to. And then some of the other options, obviously you have cash, meaning that it'll just pay you out cash outright on the annual basis. Depending on the setup, you could look at it from a quarterly cash out as well as these reduced premium options, whether it's buying paid up additions, excess left on the deposit, excess in cash. So what that means is if there's additional dividends, if it's growing a big enough dividend to where it can pay some of your premium or take care of the whole entire premium, the difference will be either buying paid up additions, putting into a savings account, or paying you out directly in cash. So if you wanted to look at a way to, as the client gets older, they don't really care about the cash, they don't really care about anything else, they just want to have a lower monthly payment, that's where these guys kind of fall into play, those reduced premium options. Everything else, it's like I said, it's going to be constant of like almost a right now approach in terms of getting the paid up additions, getting the actual deposit savings account cash wise. So if we just switch this around, so we'll see the policy, it grows a lot slower. So before on year 12, we were over that $50,000 hump, and accumulation dividends on deposit is a little bit slower cash value. So it does slow down the growth progression a little bit of the actual policy itself. Total cash value is still good, so you're still getting the interest rates on the actual whole life portion of that policy. But the actual savings account portion on this side, it's kind of that balancing effect of, do you want more death benefit? Do you want a little bit extra cash to be able to pull from? It's just really picking and choosing. To once again, depending on the client and the situation when you're doing the actual appointment, it's always worthwhile to call into Forrester so they can customize the program for you and really do multiple illustration on the phone with them, and you tell them what the client's trying to do or what their goals are, and they'll kind of direct you into what option makes the most sense for them. But like, so the gentleman landed on the phone with the Forrester's sales desk. I mean, he was pretty much saying 75% of the time people are leaving it as is on the paid up additions portion, because one, it just looks a lot better in terms of the illustration, and the actual cash growth is a lot more rapid, and the building of the policy is a lot more rapid compared to the other options as well. So you're speeding up that cycle by 3 to 4 years, which doesn't seem like a long time to us, but in terms of getting it from 46,000 to over 50,000, that's a huge chunk of time that we can get a lot more money, and then also have an accumulation of a lot more cash value happening as well. Because at that point, before we hit 50,000 on that 15th year, we're already at 53,000. You hit 50,000 almost 4 years prior. Cash values upwards of over almost 25,000. It's a lot better setup for the actual client standpoint as well. So with those, are there any questions or any of that? I'll unmute everyone real quick, ask any of those questions.
Yeah, Marcus.
What's up, John?
Hey, good morning. Okay, maybe I missed it at the beginning. I'm not sure, but yeah, I've done Advantage Plus, and I've stacked term with whole life. You're just showing different ways depending on if they want more death benefit or they can get more money out or what, or do you recommend one over the other? I mean, what's the bottom line?
The paid up additions performs better. I mean, it looks better on paper and it grows the death benefit faster. But there's certain situations, say if the client says, hey, I want to have a lower premium. I don't really care about the cash. I don't care about the death benefit. I just want this premium to get lower as I get older. Then some of those reduced premium options would make a little bit more sense for them. So every case is going to be slightly different, but for the normal person where you kind of want to get a good balance between death benefit and having cash for them to have access to, the paid up additions, the standard way it's set up is going to be probably the better option to actually use. I'm explaining those just because there are other ways of doing it and there's other thought process behind it. But in general, this is going to be the basic setup is going to be that paid up addition.
And one other thing, when you're talking about adding a term with the whole life, you couldn't do both of those on Foresters. You have to use different carriers, correct?
Nope, you can do both.
You can do both?
Yep.
With Foresters or with all carriers?
With Foresters. So they have a rider. They have a rider set up. You can add the term rider, or you can write it separate.
Okay.
But going back to the very beginning of the call, is Foresters will write a certain amount of coverage for certain ages. So it has to total up to the max. So you can't go, for example, 400,000 inside of Advantage Plus and try to do another 400,000 on a term rider. They're not going to let you do that.
Yeah.
So the most amount that they'll cover for most ages is going to be 400,000 on the simplified issue.
Okay.
Now, if you go medical, then yes, the options are endless in terms of how much coverage you actually have. But for what we're typically doing on the simplified side of things, it's the max is going to be about 400,000. That same token, the maximum accidental death would be about 300,000. So it all just depends on the age of the actual client to determine how much coverage you're able to write them for.
Okay. All right.
No, that's a real good question though. But what I was saying too, you also can write a separate term product with Foresters. So say if you wanted that example I said, we can do a 15-year term over say a 10 or a 20-year term. You could do that as well.
Okay. You can't do that with all carriers, though, right? They just don't want two policies on.
You totally could. I mean, if you really wanted to, you can. But Foresters designed this product so you can do both within Foresters. So meaning that they'll get the same living benefit options on the whole entire amount that's written versus just the whole life portion or just the term portion. Plus, most other carriers are not going to have that participative whole life. So in essence, if they're able to qualify for term itself or UL or Vantage Plus whole life, they're able to get all three of those products, meaning that almost all carriers should be able to cover them if they're eligible for term. Now, if you're looking at a whole life product on like the final expense side, where it's a little bit different underwriting itself, where the question instead of being have you ever's or the past 7 or 10 years, final expense products are asking the last 3 years. If they had, say a heart attack or something, they're not going to be eligible for this particular product. So you're looking at not doing any type of term and perm setup. It's just going to be strictly a final expense product. But for people that are eligible to have some of these products, it's a real good fit for the right money as long as it fits budget for them. Because the caveat with this particular product is the minimum is $25,000. While some of those other final expense products, you can get all the way down to $2,500 or $3,000 as their baseline whole life. So in those cases, you can still do a term and perm setup if they are healthy enough and say, hey, we only need 10 or 15,000 whole life coverage. Just put the rest inside of a term bucket. You can definitely do it that way. This is more designed for people that have a mortgage, higher balance, and they, instead of just getting a 10, 15, even a 20-year term, they want something to show for it afterwards. You would then look at the Advantage Plus or even that Smart UL option to kind of give them the best of both worlds. But for this particular training, so we're talking about using the Advantage Plus, giving them a baseline of whole life. If you use the calculator that they have built into the software on their quote tool, you use this mortgage protection needs analysis button. It'll basically let you put in their current loan principal, their annual interest rate that they're getting for their mortgage, as well as how long the loan's for. And basically it'll spit off the answer of how much whole life coverage and how much term you have to do. Because it's allotting for, after this 25th year of this mortgage, how much are they going to owe on the actual house? So during the first 25 years, it's going to be closer to that $200,000 mark. But once they get down to the last 5, the last 7, the last 10 years, it's obviously not going to be the same $200,000. So that term rider falling off after that 20th year still makes a hell of a lot more sense than having them have a bunch of coverage locked in for that 30-year period. So you kind of get the best of both worlds doing it that whole way. But this calculates their interest rate, the mortgage interest rate. So essentially, if you can beat the interest rate, which is, you can do the same thing on a Smart UL. If they have, say, for example, a really low mortgage interest rate, so some of those 3s, the 329s, like some of those older clients that they've already had their mortgage for a while, and you can beat their interest in terms of, we can spend the money inside the side of an insurance product and make more money on it than the mortgage. You can then flip them into one of these products, instead of having them, say, overpay their mortgage payment, using that extra mortgage payment divided by 12 to get the extra payments. You can then have them make more money inside of the actual insurance product, and by the 23rd to 25th year, use that cash value that it's built to help pay off the balance early, because you made more money than what you would have put into the mortgage itself. So it's that's a lot more advanced stuff that they were talking about, just going through the basics for this particular call. But that is a solid option to use in certain cases where it doesn't make some type of sense. For basic clients looking for that term as well as a permanent style setup, the Vantage Plus would be a real good fit for it.
Okay, thank you.
No, you're welcome. Any other questions, guys? I think we have Deanna, Rick on still. I think he's hopping off. No, Deanna hopped off as well. But yeah, that was today's call. Like I said, keeping it short and sweet, kind of on the same lines as last week. Kind of look at basically 2 other products that are still popular with foresters that a lot of people don't understand how they work or how to use them. So hopefully both of these sessions kind of give a little bit more insight of what these products can do, what they can offer. And if you guys find a situation where it makes sense, go ahead and try those guys out. But until then, you guys, thanks for hopping on. We'll catch you guys next week.